You are sitting at the kitchen table on a Tuesday morning. The coffee is still hot. The kids left for school 20 minutes ago, and the house is finally quiet. You are not in a rush. You have nowhere to be. You have not had anywhere to be in over a year. You pick up your phone out of habit the way you used to check your shift schedule. But there is no shift anymore. There is no schedule. There is just the notification from your banking app that appeared at 8:14 this morning. Your mortgage payment of $3,840 is due in 4 days, and your account balance is $2,112. You set the phone face down on the table. You already knew this was coming. You have known for weeks. But knowing something is coming and watching it arrive are two completely different experiences. This is not a layoff in the traditional sense. Nobody handed you a cardboard box. Nobody escorted you to the elevator. A robocall told you the plant was pausing operations. A robocall. After 22 years on the line at the Stellantis Brampton Assembly Plant, after building hundreds of thousands of vehicles with your hands, after paying into a pension and a mortgage and a life, a recorded voice on your phone told you that your income was being suspended. 70% of your base pay would continue, they said. Temporarily. For 8 weeks, they said. That was more than a year ago. Welcome back to Canada Property Watch. Over the past several weeks, we have taken you inside the bank's fraud detection systems. We have shown you the insurance blacklist that triggers automatic mortgage recalls. We have documented the white-collar purge dismantling the professional class across Bay Street and Silicon Valley North. Today, we are going back to Brampton, but this time we are not talking about fake income documents or inflated appraisals. Today, we are talking about something far more dangerous because it is completely legal. It is the income interruption trap, and it is quietly dismantling the financial lives of more than 3,000 families in one of Canada's most densely populated cities. To understand what is happening in Brampton right now, you need to understand the anatomy of a promise that was made and then broken at the highest levels of corporate and political power. In February of 2025, and Stellantis announced it was pausing operations at its Brampton Assembly Plant on Williams Parkway. The facility employed more than 3,200 workers represented by Unifor Local 1285. These were not minimum wage positions. These were skilled tradespeople, assembly technicians, quality control specialists, and logistics coordinators, earning between $75,000 and $110,000 annually with full benefits, pension contributions, and predictable income that Canadian mortgage lenders love to see on an application. Stellantis told workers the pause would last 8 weeks. 8 weeks stretched into 8 months. 8 months became a year. And then in October of 2025, while Ontario Premier Doug Ford was sitting in a meeting at Queen's Park about the very turmoil this shutdown was causing, Stellantis announced it was moving Jeep Compass production not back to Brampton but to Illinois, to the United States. The 3,000 workers who had spent decades building that brand in Canada were informed through a corporate press release. The union called it an egregious violation. The mayor of Brampton told Stellantis it could, in his precise words, fly a kite. But here's where the story stops being about corporate betrayal and starts being about something that will destroy the financial lives of people who did absolutely nothing wrong. Let us talk about the mortgage math of a Brampton auto worker. Let us call him Marcus. Marcus has been on the line at the Brampton plant for 18 years. In 2021, at the absolute peak of the housing market frenzy, but Marcus and his wife purchased a semi-detached home in the Bramalea area for $980,000. They put down 15%. Their mortgage was $833,000 at a fixed rate of 2.1%. Monthly principal and interest payments were approximately $3,600. Marcus was earning $94,000 a year. His wife worked part-time, contributing another $30,000. Combined household income of $124,000. The mortgage was completely manageable. Their gross debt service ratio was well within the bank's acceptable threshold. The file was clean. The approval was fast. The dream was real. Then the robocall came, at 70% of his base pay, and Marcus was receiving approximately $5,500 per month before taxes. After deductions, take-home dropped to roughly $4,200. His mortgage alone consumes $3,600 of that. That leaves $600 per month for property taxes, utilities, groceries, car insurance, and everything else a family of 4 needs to survive. $600. That is not a budget. That is a mathematical impossibility. Now here is where the income interruption trap closes around Marcus with the precision of a vice. Most Canadian homeowners, when they think about mortgage default, think about missing a payment. They think the bank sends a warning letter. They think there is a grace period. They think there is time to sort things out. That assumption is dangerously wrong. And buried inside the standard charge mortgage terms filed with every major Canadian lender is a clause that most borrowers have never read and most brokers have never explained. It is typically found in the covenant provisions, and it addresses what the bank defines as a material change in the borrower's financial circumstances. While the specific language varies by lender, the underlying principle is consistent across R, BC, TD, Scotiabank, CIBC, and BMO. The mortgage was approved based on a specific income profile. A permanent or indefinite disruption to that income profile changes the risk calculation of the loan. The bank has the right to reassess. Now understand the specific situation Marcus is in. His income has not been cut off entirely. He is receiving 70%, but 70% of $94,000 is $65,800 annually. His mortgage was qualified at $124,000 combined household income. His renewal is coming up in 8 months. When Marcus walks into that renewal conversation, the bank is going to perform a fresh qualification assessment. They are going to look at his current income verification. They are going to pull the T4 data directly from the Canada Revenue Agency through the same automated verification systems we exposed in our Brampton loans investigation. And they are going to see that his household income has materially declined. At the new renewal rate of approximately 5.2%, then Marcus's monthly payment on his remaining balance of $790,000 over the remaining 22 years of his amortization will be approximately $5,140 per month. That is an increase of $1,540 over his current payment. On an income of $65,800 per year, his new total debt service ratio will exceed 58%. The bank's maximum allowable ratio for renewal qualification is 44% under standard guidelines. Marcus does not qualify. The bank is not legally obligated to renew his mortgage. They can demand repayment or initiate power of sale proceedings. And this is not a hypothetical. Ardis Snow, the Brampton Assembly Plant chairperson for Unifor Local 1285, and said it publicly at a town hall meeting in February of 2026. She confirmed that workers and their families are struggling. She confirmed that members are on the brink. One veteran worker, John Muirhead, with 28 years at the plant and needing 30 to retire, told a journalist directly, and we are quoting his public statement here, that in 2 years he could be homeless if nothing changes. Another worker named Beau Besson told the same reporter that after many years of living independently, he was now living at his mother's house trying to save money. These are not statistics. These are human beings who did everything the system told them to do and are now being processed by that same system for elimination. And let us now address the employment insurance dimension, because this is where many Brampton workers believe they have a safety net that is actually far smaller than they think. Workers who were laid off and are not receiving the 70% company top-up may have applied for EI. Employment insurance in Canada pays 55% of insurable earnings up to a maximum insurable amount of $63,200 per year as of 2026. That means the maximum weekly EI benefit is approximately $668. Monthly, that is approximately $2,672 before tax. After income tax withholding, the net deposit into your bank account is closer to $2,100 per month. And a mortgage payment of $3,600 cannot be covered by $2,100 in EI. The gap is $1,400 per month. That $1,400 comes from savings, from credit cards, from borrowed money, and eventually from the forced sale of the home. Now let us look at what is happening to property values in the specific neighborhoods where these workers live. The average residential sale price in Brampton declined 6.8% in 2025. Listings increased nearly 20% while sales decreased by 13%. In the Bramalea neighborhood, which sits closest to the Williams Parkway plant and houses a disproportionate number of plant workers and their families, the inventory is quietly beginning to climb. But real estate agents in the area are reporting increased listings from households citing financial pressure. When forced sales begin to accumulate in a specific postal code, the effect on surrounding property values is not gradual. It is sudden. When Marcus puts his house on the market under power of sale pressure and the bank accepts an offer $60,000 below market value to clear the debt quickly, every other homeowner on that street wakes up the next morning with $60,000 less equity. Their HELOC limits drop. Their refinancing options shrink. The collateral damage spreads like a financial contagion block by block. And here is the dimension that connects the Brampton plant story to the broader crisis we have been documenting on this channel for months. The 3,000 workers at the Brampton Stellantis facility are not isolated. They represent a specific and identifiable cohort of mortgage holders, and the banks are not unaware of this. When a major employer in a specific geography experiences a permanent or indefinite shutdown, the risk models inside the major financial institutions update automatically. The algorithms that monitor portfolio concentration risk flag the postal code. Lenders who hold large volumes of mortgages in the L6P, L6R, L6S, L6T, L6V, and L6X postal codes where plant workers predominantly live begin to reassess their exposure. Renewal offers in those postal codes may come in at higher rates than the bank's advertised rate. Appraisals of properties in those areas may come in below market expectations. The invisible hand of the risk algorithm is already at work in Brampton before most of those workers have even realized what is about to happen to them. For the workers watching this who are on the 70% top up and believe they are safe for now, here's what you need to understand with absolute clarity. The 70% is not permanent. Stellantis has not announced a reopening date. The company's chief financial officer told analysts on a conference call that Stellantis will need to calibrate its North American investments, footprint, and employment to ensure profitability. That is corporate language for the plant's future is undecided and the workers are a variable cost to be optimized. When the 70% stops, the income interruption becomes total. The bank's assessment changes from a yellow flag to a red flag. And the renewal denial arrives not as a shock, but as the mathematically inevitable conclusion of a calculation that has been running in the background since the day the robocall came. If you are a Brampton plant worker or a family member of one, there are specific actions you need to take right now while you still have time to act rather than react. Call your bank before your renewal date and request an early renewal assessment. Ask specifically what income documentation they will require. If you are on reduced income, get a mortgage professional who is not affiliated with your current lender to run the qualification numbers honestly. Do not wait for the renewal letter to arrive. By the time that letter arrives, your negotiating position has already evaporated. If you are a homeowner in Brampton who does not work at the plant, and understand that what happens to the households on your street happens to your property value. You do not need to be a Stellantis worker to be financially affected by this crisis. You simply need to own property in a postal code where this economic shock is concentrated. For everyone else watching, for the people who were priced out of Brampton and Mississauga during the mania years, for the people who sat across the dinner table from colleagues who were bragging about their appreciation and their equity and their investment portfolios built on auto worker steady income neighborhoods, this is the part of the story that nobody on HGTV ever showed you. The same economic forces that inflated those prices are now working in reverse. The same families who could not imagine anything going wrong are discovering that a robocall from a Dutch-owned corporation and a trade war launched in Washington can reach through the front door of a semi-detached in Bramalea and take everything in 30 days or less. This is what a real housing correction looks like, not the sanitized version in the newspaper. The version that happens at kitchen tables with phones face down and coffee going cold. In our next investigation, we are going to expose something that affects every single homeowner in Canada, regardless of whether you have a mortgage or not. We are going to show you how a municipal government can legally seize a fully paid off home. No bank involved, no court order required, and nothing more than an unpaid property tax bill and a clause buried in the Ontario Municipal Act that the city is now activating at record rates across the GTA. We have been tracking the auction lists. The numbers are shocking. Subscribe to Canada Property Watch right now because this next video is something you cannot afford to miss and something no mainstream outlet is willing to tell you.